Ja, ja. We zitten 1, 2, 3. Ja, hoorde jij mij?
Ja.
En, hoorde mij nog?
Ja.
Nou, dan is het goed, hè. Ja, gaan we wachten nu dat een dater daar is gaat babbelen.
Check, check. 1, 2, 2, check. Sa, su, sa, si. Ontvang jij mij goed? Test 1, 2, 1, 2, sa, su, sa, si. Goedemorgen, dames en heren. Welkom hier in de Pieter de Zomer. De eerste slides. Ja.
hier moeten komen zitten dan.
Ja, ze gaat dus voor mij niks dat we opschrijven, ICT-support. Ja, dat is goed. Of niet de eerste stoel, als het ergens aan de tafel staat, dat is makkelijk. Dit is het tweede zitje. Maar je gaat de eerste stoel aan de deur. Aan de deur? Ja.
is dat oftewel hier oftewel aan zijn linkerkant. Zo, maar hier om de boom.
Ja, oké.
Er is dus net iemand komen zeggen dat er niet moeten uitgedeeld.
Ah, dat is een grote. Dat is een grote. Hier is bezig. Ah, jawel. Het staat heel stil, hè? Volgens mij. Ook in die gang. Ja. Dear Ministers of State. Nee? Dear Ministers of State, dear Members of Parliament, dear Rector, dear Honorary Rectors, Vice Rectors and Deans, ladies and gentlemen. It's an honor to introduce you to Professor Thomas Piketty, who holds the 2015 Gaston Eyskens Chair. The Gaston Eyskens lectures were introduced at the occasion of the promotion of former Prime Minister Gaston Eyskens to Emeritus Professor. In his academic career, Professor Gaston Eyskens always had a keen interest in public policy. Since the Gaston Eyskens lectures combine outstanding scholarship with a focus on important policy-relevant questions, they are a central part of the legacy of Professor Eyskens. The biennial lectures have hosted a series of prominent scholars in the past in various areas of economics. The first holder of the chair was Richard Musgrave in 1977. Previous holders of the chair include Nobel Prize winners James Tobin and Paul Krugman. More recent holders of the chair were Daron Acemoglu and Olivier Blanchard. The current holder of the chair is a perfect fit with this rich tradition. Professor Piketty combines an exceptional academic curriculum with a strong interest in the challenges that current societies are faced with. Thomas Piketty is professor of economics at the Paris School of Economics. At the age of 22, an age at which most students are still struggling to finish their undergraduate thesis, he obtained his PhD at the London School of Economics. Shortly after, he took up a position as professor of economics at MIT, which was followed by various academic positions in French research institutions. Professor Piketty published extensively in the major journals of economics, such as Econometrica, the American Economic Review, and the Quarterly Journal of Economics. In addition to numerous academic papers, he published about a dozen books. In his work, he has been focusing on the relation between economic development and the distribution of income and wealth. He is further one of the initiators of the World Top Incomes Database, an extremely useful source for researchers as well as policymakers. In 2014, he published the book Capital in the 21st Century, which is a translation of Capital au XXIe siècle that was published a year earlier. Perhaps somewhat unexpectedly, the 700-page book became an instant bestseller and attracted an immediate and worldwide attention. It led to the first rockstar economist, as the media quickly called Thomas Piketty. Actually, you are testimony of the success of this book, since this must be the most diverse audience in the history of the Gaston Eyskens lectures. So, high time that we learn more about this famous book, or infamous according to some. In the next 1 hour and a quarter, Professor Piketty will deliver his Gaston Eyskens lecture. In the last 10 minutes, there will be room for a few questions from the audience. Thomas, the floor is yours.
Thank you. So let me first, apologize that my English sounds a lot like French, but at least for all of you who know French, this should be familiar, and I hope you will be able to understand what I have to say. So let me also thank you for inviting me to this lecture, and I have learned a lot about Belgian politics over lunch, and I'm looking forward to the questions, to continue the discussion about some of the policy implications of this work on inequality for today's politics, particularly in the Eurozone. So this presentation is going to be based on my book, Capital on the 21st Century. Let me say very clearly that this book comes from a very collective international research project, and there's no way I could have collected all the historical data that I present in this book on my own. So I started working on the history of income and wealth in France about 15 years ago. And then I was very fortunate to find many other co-authors and scholars who worked with me. Tony Atkinson starting to collect the same data for Britain, for South Africa, for many other countries around the world. With Emmanuel Saez, we've been working on the case of the US, with Facundo Alvaredo on Argentina and Spain, with Abhijit Banerjee on India, with Nancy Chian on China. And so I cannot list them all, but this has become a very international research project. We have put together what is the largest existing historical database on inequality. And the purpose of this book is to put all this material together and to propose an interpretation for what we find. But let me say very clearly that I am much better at analyzing the past than the future, and I don't ask readers to share all of my conclusion about the future. And ultimately, we still know too little about inequality. We know a little bit more than we used to before we started collecting this data, but we are in the social sciences. There's no way to be completely sure about the interpretation that we propose for the evolution that we find. So my objective is really that people can draw their own conclusion, can read this book, and contribute to a more informed democratic discussion. And I think the success of the book shows that there is a strong demand for this form of democratization of economic knowledge, and issues of income and wealth and public debt and inequality are not technical issues, and they should not be left to a small group of self-proclaimed experts, and they are important issues for all citizens. And at the end, the objective of this research is to contribute to a more informed democratic discussion, not to deliver a final conclusion. So probably the main general lesson that comes from this work is that when you look at the history of inequality or public debt or other issues like this, history tells you one thing, which is that there are always alternatives. There are always different policies to solve problems, and there's no easy solution, but there are different ways. So if you think, if you look at the history of public debt, which is something we care a lot about the Eurozone right now, the good news is that when you look at the past, you observe episodes of public debt where, it's even bigger than what we have today. And the good news is that we've always found ways to get around it. So, you have example in Europe, and I talk about this in the book, where you see major countries in Europe, including Britain, Germany, France, that have more than 200% of GDP in public debt, so even more than Greece today, and with a much larger share of European GDP. And we've always found ways to get around it. So, and there are different ways. So, in the 19th century, Britain had over 200% of GDP in public debt. The way they reduced it is through the slow accumulation of budget surplus. The good news is that it can work. The bad news is that it takes a very long time. So it took them an entire century, basically, of budget surplus of 2-3% of GDP. So, you can do that. There was no inflation at the time. It worked, but it takes a very long time. In the 20th century, Germany or France had over 200% of public debt, GDP in public debt in 1945. And in 1955, they were back to zero. What happened? Well, of course, they never reimbursed this public debt. This was destroyed by inflation and by restructuring of debt, and we all know very well the German foreign debt in 1953 that was brought down to zero. Now, I think it's important to remember that in many ways the European integration in the 1950s was based on debt restructuring and debt forgiveness, because the big strategy was to invest in the future and to say to the young generation of French and Germans, your parents have made lots of mistakes, but even bigger than the Greek government mistake in many ways. But this is not what matters. What matters is the future. And you're not going to repay budget surplus during the next 50 years or 40 years. We are going to invest in growth, in education, in infrastructure, and this contributed to the large growth performance. So I think, looking at history is important. I'm not saying you can do exactly the same solution. It's always a different context, but the good news, again, is that problems of public debt or problems of inequality that I'm going to focus on today are not new. We already have big crises, big inequality crises in the past during the Industrial Revolution. We have big public debt crises in the past, and there are different ways to solve this problem, and we can learn a lot by history. So, it's always difficult to have a quiet discussion about inequality and taxation and debt restructuring, and people get very excited very quickly. But, looking at history, looking at past episodes can be a way to try to quiet down the debate and say, well, look, there are ways, we have already done it, let's look at it carefully. So that's the general perspective in which I study history. And so today, I will present a number of selected historical evolutions. So of course, I cannot present everything that's in the book, but all statistical series that are used in the book are available on this website. And more generally, if you go to the website of the World Top Income Database, we put new material online almost every week. So this is an ongoing process. As I said, we still know too little about inequality, and there's a lot of disagreement and controversy about inequality, and that's perfectly fine. That's part of the game. I have no problem with this. Let me just say that we're trying to make more and more progress, and we're trying to put new countries. So the countries in red are already in the database. The countries in blue are entering the database. One of the good impact of the publication of the book is that this induced a number of governments, like in Brazil, or now you should have also Mexico, should be in blue, who used not to open their fiscal data, and partly because of the success of the book, they were induced to open their data sources, and in particular historical income data sources. And so this is I think, important to have more transparency about the dynamics of inequality. So, what does it mean to be in the database? Well, initially we started to work on the historical evolution of income, and now we are more and more pushing it towards the distribution of wealth. In both cases, the oldest data sources about income and wealth usually have to do with the historical development of the tax system. Okay, so like in the United States, the federal income tax was created in 1913. And Kuznets, who was an American economist, well, he was born in Ukraine, but he became American, and he was the founder of the first national accounts of the US during the interwar period. And then in the 1950s, he was the first economist to use US income tax data, which started in 1913 with the creation of the federal income tax, and he used the data until 1948. And he was the very first one to compute a statistical series on income inequality, and he came with a very optimistic conclusion, which was a reduction of inequality in the US between 1913 and 1948, and we will see this later, with a big reduction in the share of total income going to the top 10%. Now, he had only one country over a 35-year period, but this was a lot more than before. People that had been talking about inequality forever in the 19th century, Ricardo, Marx, etc., but they had no data, which puts limitation on what you can say. Well, the problem is that it puts no limitation on what you can say. And so, at least when you have data, the data is always imperfect, but it's better than no data at all. Okay? And so what we've done in this research, in many ways, is just to extend the work of Kuznets to many more countries and many more years. Okay? And this was not done before, I think, largely for bad reason, which is that this was viewed as too historical for economists and too economic for historians, so nobody was really collecting this historical tax data. Also, to be honest, it's much easier to do this kind of research project today than at the time of Kuznets. And so Kuznets did not have Excel, he didn't have computer technology, he did almost everything by hand. So today, we can do this kind of project at a much bigger scale than we used to. So, we are just benefiting from this. But anyway, this is, the general picture. What's important to have in mind is that taxation is not only about taxation, it's also about producing information. So when you don't have the income tax in the 19th century, you don't have information about income. So like in France, the income tax was created in 1914. In the summer of 1914, the parliament finally accepted to create an income tax. This was not to invest and pay for schools, this was to go to war with Germany. This is a sad story, but this is a story of Europe. And in the 19th century, before 1914, there was no income tax, so there is no data on income. Like in France, you have the contribution des portes et fenêtres, so you have all sorts of wonderful data on the number of doors and windows by department, which is fascinating material, but you don't have information about income. So taxation is also a way to produce legal categories and statistical categories so that societies can learn more about themselves and how they change over time. Okay? This is the same for wealth. And for wealth, we have older data sources because the taxation of property, property tax and tax on the transmission of properties through inheritance are much older than income tax. In France, the modern inheritance tax system was created by the French Revolution, so we can go back to the late 18th century. But again, the registration of wealth is also about producing information about property. It's also about securing property rights, which is important to organize an economy. And so this is the general data framework that we use. So what do we learn from this, putting all this historical data together? So I'm going to try to make 3 points in this presentation. First, about income inequality, and then about wealth. So the first point about income inequality, I will talk about what I call here the end of the Kuznets curve, the end of universal laws. And the general conclusion is that institutions and policies matter, both educational policy, labor policy, tax policy, if you want to understand the long-run evolution of income inequality. And the idea is that there's a general law, for instance, in the case of the Kuznets curve, the view in the 1950s, 1960s was that there was a natural decline of income inequality in advanced stages of development. Well, I will argue that there is nothing natural in this evolution, that this really all depends on particular institutions and policies that we choose. Then I will turn to wealth inequality. First, I will talk in the second point about what I call in the book the return of a patrimonial or wealth-based society with higher wealth-to-income ratio, and I will show you the big increase in wealth-to-income ratio in recent decades, which is not necessarily bad in itself. It all depends on the concentration of wealth, and the third point will be about the future of the concentration of wealth. Okay, so it's important when we talk about wealth to distinguish between the total quantity or market value of wealth relative to income, and then inequality of wealth. And sometimes people confuse the two, but in itself, the fact that we have a larger ratio of wealth to income, if everybody has an equal share in some gigantic pension fund or housing stock, there's no problem at all. Wealth is great, capital is great. It's so great that I would like everybody to own part of it. And so that's, it's important to distinguish the quantity, the volume, value effect from the concentration and inequality effect. Okay, so let me start with the first point, which is about the long-run dynamics of income inequality and the end of the Kuznets curve. So I'm going to show you 3 simple facts about inequality in the long run, one about income inequality, one about wealth inequality, and the other one about wealth-income ratio. If you want to see, these 3 facts, they are presented in a very short manner. I'm sorry that my book is so long, it should not be so long, but on the other hand, it's putting a lot of historical material together. At least this article, Science, they want very short articles. So this is like a 6-page article. You can find it online on my webpage. So, if you don't want to read the book, you can read this 6-page. You have a quick summary. And so what you will see in this article are these 3 facts together. First, fact number 1 is that if you look at income inequality, you have a big reversal between US and Europe, broadly speaking. So you have more inequality in Europe a century ago and much more today. So let me show you an example. So this is the share of total income going to the top 10%. So you see that it generally fluctuates between 30 and 50%, so between 1/3 and 1/2 of total income going to the top 10%. This is the typical order of magnitude we have for income inequality. For wealth inequality, as we will see later, it's a lot more concentrated. So for wealth inequality, the share going to the top 10% is typically between 50 and 90%. So it's always higher than the... For income inequality, it's typically between 30 and 50%. You find very unequal societies like Brazil or South Africa, where it will be higher than 50, maybe 60, sometimes up to 65%. But that's really very, that's the most you see. Now, in this band, 30 to 50%, you can see you have very large variation. So on this figure, I show decennial averages so that everything looks very smooth. And I will show you the same figure with annual data just after, and you will see that the yearly evolution is much more chaotic, but I think both are interesting. It's important to see the long-run picture, and then we can look at the short-run chaos. So the long-run evolution is pretty clear. You used to have very high inequality level historically at the beginning of the century, with Europe a bit more unequal than the US. So when I say Europe, Europe is a complicated continent, of course. So this is the weighted average of France, Germany, Britain, Italy, Sweden. So this is not all of Europe, but the evolutions are pretty similar for the different Western European countries for which we have historical data. So to simplify, it's legitimate to look at Europe versus US. And so you have this big reversal with a big rise in inequality at the end of the period in the US, which in Europe you don't have. Well, you still have a rise, when you go from 30 to 35% in Europe of total income going to the top 10%, given that you have very low growth in this recent decade, this still means that a very big part of this low growth is taken by the top. So for people in the bottom 90%, this can be a bit upsetting. But as compared to the US, this is much less spectacular. Okay? In the US, this is really spectacular. If you look at the annual series for the US. So, it depends whether you include or exclude capital gain. So capital gains is the income you make by selling typically your share on the stock market. So of course, this is a very cyclical component of income. If you, in 2001, 2002, just after the internet bubble crash, this is not a good time to sell your portfolio and to realize capital gains. And again, in 2008, 2009, this is not a good time. But, in 2012, they have really already recovered to a level of inequality that is higher than in 2007, which itself was a bit higher than 1928. Okay? So many people looking at this graph in the US, of course, thought, well, maybe rising inequality is not so good for macro stability, because already in 1928 and then 2007, you have very high rise in inequality and then you have a crash. It's the relation between inequality and crisis is a complicated one. It's partly a correlation rather than causality, in the sense that when you have a booming stock market, at the same time, this is increasing income at the very top, and this is making the financial system more fragile. So that doesn't mean it's causal relation. I think it's also partly causal in the sense that, I think many people now agree in the US that the huge rise in inequality that happened until 2007 contributed to the stagnation of median household income, and also contributed to the rise of household debt, and in the end contributed to make the financial system more fragile. In any case, whatever is the relation with macroeconomic crises, what I want you to remember is that even if you take away the capital gains, you have a big increase in inequality. You look at the triangle, and what I also want you to remember is the contrast with the post-war period. So when Kuznets wrote in the 1950s, he found the big decline in inequalities that we have here, and we agree with Kuznets. We have no problem with Kuznets. He didn't have Excel, but he did the computation right, and we redid all the computation. We have no disagreement. The difference is that now we have more years of data and we have more countries, and this gives a very different picture of inequality dynamics, because in the post-war period, like in the 50s, 60s, 70s, when you have a stable share going to the top, about 1/3 of total income going to the top 10%, this means that, everybody is growing at the same speed. So this is sort of the post-war ideal of balanced growth. This means that, if you have 2% or 3% growth rate in 1950 or 1960 or 1970, everybody is growing at the same speed. The average income of the top 10 is growing at 3%, the average income of the bottom 90 is growing at 3%. So, you have rich people, you have poor people, but everybody is going up at the same speed. So this is what a stable share to the top means. Whereas in the recent period, well, in the post-1980 period, you have such a big increase from about 1/3 to 1/2 that in effect over 2/3 of aggregate US economic growth was absorbed by the top 10 over this period. So the remaining growth, given that the growth rates were also lower in this period than in the 50s, 60s, 70s, the growth that remains for the bottom 90% was really close to zero. Okay? So that's a concern, and I think it's important to realize that the numbers are big. When you go from 1/3 to 1/2 of national income going to the top 10%, it's not just a few rich people who are making a lot of money. If it was just a few, a football player or artist, who make a couple of million, nobody cares after all. If they give us a good show, that's fine. But here we are not talking about this. We are talking about big numbers. When you go from 1/3 to 1/2 of national income, you have to ask yourself, where is this going to stop? Is this going to stop right here at 50%? Is it going to go to 60, 70? You cannot just say, okay, wherever it stops, we'll be fine. I think the numbers are sufficiently important that we ask ourselves, okay, do we understand what's going on? Do we understand where we are going, and what can affect where we are going? So in order to make progress, making international comparison is a first start. It's not perfect, but that's the natural start. And what's striking is first this difference between US and Europe. So you have rising inequality everywhere in the post-1980 period, but much more in the US than in Europe. If you put Japan on the picture, which is the third part of the rich world, it's sort of in between Europe and Japan and the US, but closer to Europe. So how can we interpret this different evolution? Okay, so sometime when we see this evolution, with rising inequality, many US economists say, well, this is very simple, this is globalization and the rise of new technology, digital technology, and globalization also with the rise of China, with all the labor force of China entering the world labor market, and this is pushing down wages in developed countries. And look, I think this is part of the story. I think globalization, digitalization is important, but globalization, technical change also happened in Japan, in Germany, in Sweden. It did not only happen in the US. So that's not enough. You're not going to explain why you have this huge differential. If you look at the GDP per capita in these different countries, Japan, US, Germany, Sweden, it's very close. It's almost the same productivity, hourly GDP per hours of work. So you have the same technological evolution, the same globalization process, but different evolution of inequality. So you need explanation in addition to just the general factor of globalization and technical change. You need probably some country-specific institutions or policies. So what can be these differences? Well, there are several stories. There's not a magic bullet to explain everything. There's a sequence of factors that play a role. Probably more unequal access to skill in the US is important. Rising tuition fees and insufficient public investment in education. There was a proposal by Obama earlier this year to increase public investment in public universities, but this was not accepted by Congress, so this is not going to happen. But probably more equal investment in higher education is part of the solution. You also have an unprecedented rise in top managerial compensation in the US, which is very difficult to explain simply on the basis of education and productivity and skills. When you pay top managers $10 million rather than $1 million, it's very difficult to find in the data the kind of extra productivity or job creation that you would expect if this was, the reason, or at least I could not find it in the data, but, maybe we find the data one day where we get it. But at this stage, I think in order to explain this huge rise in very top managerial compensation in the US, you need to look at institutions, at the change in corporate governance, the changing ability of top managers to sometimes put the right people in the right compensation committee, change in the tax system. The US used to have the most progressive income tax system in the world, with top rates of 80-90%. It suddenly went to less than 30% under Reagan, and certainly it changed a lot the incentives for top managers to fight hard in order to get a pay increase. You know, you always want to get 1 million more, but when it's 80-90% tax rate, you know, everything is going to go straight to the treasury, so maybe your shareholders and your subordinates will tell you, okay, you should quiet down and, you know, we'll find other ways. Whereas when it's 20-30% tax rate, you know, this has changed the name of the game in top corporate pay setting processes on the other side of the Atlantic. Labor market institution, also the role of unions, the role of minimum wage, and I'm going to show you more on this in a minute. So, you know, whatever the exact combination, you know, between unequal access to education, change in corporate governance, change in the tax system, change in labor market institution, unions, minimum wage, it's really a different set of policies and institutions which I think explain why you have, you know, different trajectories. So that's very important, because this means that, you know, it's not just globalization. You know, sometimes when people say, well, rising inequality is globalization, it's a way to say, okay, there's nothing we can do because globalization is good for other reasons, so there's nothing we can do. But, you know, I think there are different policies and institutions that allow countries to make a bigger part of their population to benefit from globalization. And so that's, you know, institution and policy matter. So just to illustrate this, let me show you a couple of graphs on first minimum wage and then access to higher education in the US. So here I compare the evolution of the real value of the minimum wage in the US and France. So this is expressed in euros and dollars of today. So this is purchasing power. So when you have a decline in the US, like during the 1980s, during the Reagan years, well, this is because of inflation. This is because you have a fixed nominal minimum wage, and you have inflation that's taking 2-3% each year. So here everything is expressed in dollars or euros of 2013, and I have put €1 equal $1.2, so it's almost purchasing power parity, so you can sort of compare the level. So you can see that the US used to have a much higher minimum wage than France, and now France has a much higher. So, you know, some people in France believe that minimum wage is too high. I think it's more a matter of the payroll tax that goes on the top of the minimum wage, but, you know, that's a complicated debate. Certainly, I think the minimum wage is too low in the US. You know, I think $7.2 per hour. So Obama earlier this year proposed to raise it to $10 or $11 right away, and many US labor economists feel that it would be perfectly fine to do that. And in fact, so Congress did not vote this, so this will not happen for the time being. But you could see that even if this had happened, in effect, this will be, you know, Obama would have put the US back to the 60s. Okay? So in the 60s, the minimum wage in the US in terms of purchasing power than today was more than $10. $10.5. So it's quite striking, you know, to see a country which over the course of half a century has reduced the purchasing power of its minimum wage in purchasing power terms, you know, not in relative terms relative to high income, but in absolute terms. And in spite of the fact that, you know, back in the 60s, you know, there was no more unemployment than today in the US. So, you know, 95% of the labor force was employed above $10 per hour. And today, 50 years later, you still have, you know, 95 or 94% of the labor force employed, but with a lower minimum wage. And so I think there is a lot of evidence that, you know, this kind of policy, in particular minimum wage policy, has an impact, and that this contributed to rising wage inequality in the US. So, of course, it's all a matter of level. If you just increase the minimum wage again and again, that's not going to be okay. So, you know, this kind of policy, you know, is very much complementary with other policy like investment in education and skills, so that people can take high productivity jobs and higher paid jobs. So to move to education, let me show you this simple illustration of unequal access to education in the US. So this is taken from research by Emmanuel Saez and Raj Chetty at Berkeley and Harvard, who had access to the exhaustive administrative data set on income tax files in the US, and they could relate to the social security numbers of students, so they can link the parents and the children. So this is the situation today. You know, this was computed for the students who are in university between 2008 and 2013, so this is like yesterday. And so you can see, so this is the percentile income rank for the parents, and this is the probability to be in college at age 18 to 21. So you can see you get almost a straight line, and it's almost the first diagonal. So you go almost from 0 to 100. Well, not quite. You know, if your parents are in the top 10%, you have only a 90% chance to go to college. And if your parents are very poor, you still have a 20% chance to go to college. So it's not exactly go from 0 to 100, it goes from 20 to 90. But, you know, this is very extreme. And in addition, you know, keep in mind that the people at the top, they don't go to the same college or university as people at the bottom. Okay, so in my book, I give some data. You know, right now, the average income of the parents of Harvard University students corresponds to the average income of the top 2% of the US distribution of family income. So, you know, this is an area where the gap between the official meritocratic discourse about equal opportunity, etc., and the reality is huge. So, you know, the level of hypocrisy that we all have, not only in the US, but, you know, in Europe, in my country, in France, you know, we are able to spend 3 times more public resources on the students going to the grand écoles and those going to the basic university curricula, where typically the most disadvantaged social groups tend to go. So, you know, in every country, there's a lot of hypocrisy about meritocracy, and we like to talk about meritocracy, equal opportunities. But, you know, I think sometimes the elites have a lot of imagination, you know, to justify inequalities and to tell stories. And, you know, sometimes what they say can be right, but sometimes it's wrong. And I think it's important to put these claims under public scrutiny. And so that's why it's important to have transparency, access to data, information, so that we can compute this kind of information, and we can follow, you know, how public spending investment is distributed, who's paying tax, but also who's benefiting from spendings, and that's very important. And so this extreme level of inequality in access to skills, particularly in the US, I think has a lot to do with very high tuition fees for universities. So in Europe, you have lower tuition fees, to some extent more equal access to education, and I think that's part of the reason why the rise in inequality has been less extreme. So, you know, in the US, you have top universities are excellent, people going to top universities are very well trained, but people in the bottom 50% of the population, you know, they don't have very good skills, and that's part of the reason why you have huge inequality. Now, that's not a reason to be satisfied about the situation in Europe, you know, especially with the huge unemployment right now, but I think this partly explains the bigger rise in inequality in the US, and more generally, this illustrates that institutions and policy matter. So now let me move to the second point about wealth accumulation. Okay, so first point was about income inequality. Second point, I'm going to talk more about wealth accumulation, and third point will be about wealth concentration, so inequality in wealth ownership. Now, of course, wealth accumulation and wealth distribution partly comes as a consequence of income distribution. So, other things equal, if you have more unequal distribution of labor income, you will have more unequal abilities to save, accumulate wealth. So this will just be, wealth inequality will just be a translation of inequality of labor income. So all the factors I have mentioned, labor market institution, inequality with respect to education, etc., this will matter for wealth distribution as well. But there are other factors in addition that matter to explain wealth inequality, rate of return to wealth, the working of financial markets, transmission of wealth across generations. So wealth inequality is typically higher than labor income inequality and involves more issues which I think in the long run are even more important than distribution of income, because the distribution of wealth determines the distribution of economic power, the distribution of opportunities to invest in different types of economic activities. So I think it's worth spending a lot of time on wealth, and in a way, you know, my book talks both about income and wealth, but spends more time trying to draw the consequences for wealth in the long run. So my first point about wealth will be about what I call in the book the return of a patrimonial or wealth-based society, and the basic fact that we will see is that wealth-to-income ratios seem to be returning to very high levels, particularly in rich countries, particularly in Europe and Japan. And the basic intuition is that in a country with slow growth and particularly slow population growth, wealth accumulated in the past can naturally become very important. And in the very long run, this can be relevant for the entire world, for other countries. Now, this is not bad in itself. Again, in particular, if this is because of population aging and you accumulate more for your old days and pension funds, that's perfectly fine. The only problem is that this creates new policy challenges, both in terms of financial regulation, in terms of access to property, and so generally speaking, what I will try to argue is that the metamorphoses in the different forms of capital and property relation and assets call for new regulations. And I will stress also the key role of the legal political system and the general issue about democratizing capital ownership, which also involve issues about worker co-determination or patent laws today, and not only taxation. So remember fact number two. Fact number one was about the reversal of income inequality. Well, fact number two is that wealth inequality is always a lot higher than income inequality, and that you also have this reversal between the US and Europe over time. And fact number three is that, this happens, wealth inequality today is less extreme than a century ago, in spite of the fact that the total capitalization of private wealth relative to national income has now recovered from the World War shock. So that's where it's important to distinguish between the total value of wealth and the inequality of wealth. So wealth inequality, as you can see, remember for income inequality, it was always between 30 and 50% for the top 10. Well, now for wealth inequality, it's always between 50, 60, and 90%. Okay, so wealth is always a lot more concentrated. What you should have in mind also is that whatever does not belong to the top 10 belongs to what I call in the book the middle 40, the people who are not in the top 10 and who are not in the bottom 50. So the bottom 50%, basically they always own nothing at all. The share of the bottom 50% for pretty much every country on which we have data, including today, in France or in Belgium, is always less than 10% of total wealth and usually less than 5% of total wealth. So for most people, for say half of the population, wealth is a very abstract notion. People have, maybe one wage in advance, 1 month of wage in advance on their bank account, or a few months, or maybe they have a house, but they have a liability, a debt that is as big as their house, so their net wealth is very close to zero. So, for half of the population, their wealth in terms of years of income is very small. And so when you have a reduction in the share, start after World War I, between World War I and the 1950s, 60s, you have a big reduction in the share going to the top 10. Well, this corresponds to an increase in the share going to the middle 40%. So this is what I call in the book the rise of the middle class, the fact that today, the middle 40%, they own 20, 30, sometimes up to 40% of total wealth, which is, still less than what the top 10% owns, in spite of the fact that they are 4 times more numerous. But this is a lot more than at the beginning of the century. Until 1910, you had, in Europe in particular, you had 90% of total wealth for the top 10, which means that there was no middle class. Basically, the bottom 50 would own 5% and the middle 40 would own 5%. So the middle class was just as poor as the poor. You will go directly to the group of people who don't own anything to people who own everything. So there was no real middle. So that's a major change that today we have a real middle. And today the middle class as a share of total wealth is much bigger than a century ago, particularly in Europe. But in the recent decades, the share going to the top has started to increase again. So it is still much less than what it used to be, but it's not going in the right direction. Or at least, the share going to the middle class is going down. You have a shrinking middle class, and many people feel that this is not good for democracy, it's not good for the economy, that it's important to have a strong middle class and a strong share in aggregate wealth. So one of the big questions is why is this happening and what's going to happen in the long run? And of course, I don't have perfect answer to this because there are so many processes that are involved, but that's what I'm trying to understand. So first, we will try to better understand the evolution of wealth-income ratio, which measures, so this graph is not about inequality in itself. This is about the total value of wealth divided by national income. So you can see that following World War I and World War II, the total value of wealth in Europe declined a lot, and then it has been rising in recent decades. This is true in pretty much every European country for which we have data. You know, you see Germany, France, UK, but this is the same for all other European countries for which we have data. So you have different levels. You can see the value of wealth as a fraction of national income is less in Germany than France, UK. That's partly because of the lower housing prices in Germany, which itself is due to a number of reasons about the geography of Germany, unification, all sorts of reasons, but also the lower stock market prices in Germany, probably partly related to co-determination, and this is not necessarily a bad thing to have lower market value for wealth, and I will say a bit more about this in a minute. But in any case, you have the same evolution. You know, even though you have difference in levels in the market valuation of private wealth in Germany compared to France and UK, the same evolution, which is really quite striking. Now, this increase in the wealth to income ratio over recent decades, again, it's certainly not bad in itself. You know, this is called capital accumulation, this is called reconstruction, and, you know, we should certainly not be nostalgic of 1950, where a lot of the wealth had been either destroyed by physical destruction during the war, or because there was insufficient investment between 1910 and 1945, where a big part of the private saving was used to pay for the war, which itself was used to destroy the other part of the capital stock. So that's a stupid process, but, you know, this is how life goes, and the third reason, actually, you know, 1/3 of the fall is physical destruction, another third of the fall is insufficient investment, and the third part of the explanation is because the relative price of assets in 1950, 1960 are historically very low, partly because of policy. So, you know, if you have a rent control policies, it's reducing the price of housing. If you have nationalization, this tends, of course, to reduce the stock market capitalization. So this was partly voluntary. This was also a way to reduce the sort of private control over assets. This did not always work very well, but at least this was man-made. You know, this was part of the policies that reduced in the end the market value of wealth. And the rise in the recent decades also involved a mixture of factors having to do with real accumulation and with recovery in asset prices. So let me again insist, you know, there's nothing bad with high wealth income ratio in itself. You know, it reflects post-war reconstruction. It reflects the slowdown of growth at the end of the period, which makes you know, if you keep saving and investing and you have a low growth, you know, you accumulate more wealth relative to income. This also tends to contribute to housing bubbles, because you have to put the money somewhere, to invest it somewhere. So I think there's a big relation between the growth slowdown and the housing bubbles. Now, this is not bad necessarily in itself, but this creates new policy challenge, in particular for financial regulation, real estate bubbles, return of inheritance. And the general point I'm trying to make in my book is that in order to regulate capital relation and capital accumulation, you need to develop a multi-dimensional approach to capital and property relations. So just looking at the big total value of capital is not enough. And so one reason why my book is so long is because I try to open the black box and look in a very detailed manner at agricultural land as opposed to business assets, foreign assets, real estate, public debt, immaterial capital, and all these different forms of wealth call for different type of regulation. I'm not going to talk about everything here. Let me just make a couple of remarks. First, in the very long run, you have a complete transformation in the nature of wealth. So this is the best data we have for Britain, where you have national wealth estimates for the 18th, 19th century, which are reasonably reliable. Agricultural land used to be a big part of wealth. It has now disappeared, or it is a very small part of wealth. Housing is now much bigger. Other domestic capital is also much bigger. Foreign assets used to be very large. You know, in Britain owned a big part of the rest of the world in 1910. This disappeared following World War I and World War II. So these are major changes in the nature of wealth and the nature of property relation. But the total value of wealth today, in the end, is close, or is getting close to the level we had in the 18th, 19th century, but with a different structure of property. You have similar evolutions for France, except that agriculture, it took more time for agriculture to decline as a fraction of GDP and capital, and foreign assets were a bit less enormous than for Britain until World War I, but they were very large as well. If you now look at more countries and focus on the more recent period, so now I'm going to look more at the period 1970 to 2010, and so these are the 8 largest developed economies in the world: US, Japan, Germany, France, UK, Italy, Canada, Australia. So you can see that you have a tendency of a rise everywhere. So this is private wealth relative to national income, and I will talk about public wealth in a minute. So private wealth is household wealth. Roughly, half of it typically is housing and half of it is financial and business assets. When I talk about wealth, it's always net of debt, of course. It's always net of all liabilities, because if you have a lot of assets but a very big liabilities, this is not wealth. So this is always a net wealth concept, of course. Now, you can see that this has increased a lot everywhere. So this is important because, sometime in economic textbook, you hear that wealth to income ratio or capital to output ratio should be a constant. Well, as you can see, this doesn't look too much like a constant. And so be careful with economic textbook, because, sometime in economics, when we don't know much about something, we just assume it's a constant. And of course, if you have only one data point, everything is a constant. But, when you have more data, clearly you can see it's not a constant. And when you take a longer run perspective, it's even clearer. But, you take 1970 to 2010, every country, so this is half of the world GDP. Okay, this is the top 8 developed economies in the world. So all countries were between 2 years and 3.5 years of national income in private wealth in 1970, and now all countries are between 4 and 7. So if you come with a theory that tells you this should be a constant, you are in trouble. So let me make clear that there's absolutely no reason why it should be a constant. So even in our simplest economic model of capital accumulation, which is a one good model where, the consumption goods that you produce is the same goods that you accumulate. So capital is just a big pile of apples, and, you eat apples and you use apples for capital equipment. And, don't ask me why you have a big pile of apples for capital, but, this is the story. At least the advantage is that you don't have relative price of assets, and so accumulation in this model is just you put new savings, so new apples each year. Now, even in this simple model, which is not realistic at all, but the capital output ratio or wealth income ratio has no reason to be a constant. If you have what we call capital labor substitution in the production function, any ratio of capital to output can be an equilibrium. It all depends on how much you save and invest relative to how fast you grow in the underlying population growth and productivity growth in the economy. Now, when we move to more realistic model, where you have bargaining power between owners of capital and workers, and changing capital and labor share, because where you have a different capital good, so you have relative price, for instance, of housing, which matters, relative price of companies that matter relative to consumption goods, then there's even less reason that this should be a constant. And you find even more reason for huge variation in the wealth to income ratio. So housing bubbles in particular are a big part of this evolution. So look at Japan between 1985 and 1990. This is the famous Japanese housing and stock market bubble of the late 1980s. So they go from wealth of 500% to 700% of national income in just 4 years, between 1985 and 1989. Now, even with a Japanese saving rate, you cannot accumulate wealth so fast, because to increase your wealth by 2 years of national income in just 4 years, you will need a saving rate net of depreciation of 50% of your national income, which you never see. Even when you have investment or saving rate of 30 or 40% in China, these are gross of depreciation. Net of depreciation, it's 20, 30 at most. So and at that time in Japan, it was less than that. So the big increase here is due to a price effect, not to a volume effect. It's really the price of capital that's increasing. And you have the same, at the end of the period in many countries, so following 2008, you have a fall in housing price, for instance, in particular in the US. Now look at Spain. So this is Spain over there. So you see the Spanish bubble, is even bigger than the Japanese bubble, the simple message. So, the fact that you have very high wealth to income ratio, this is not a problem in itself, but this can create difficulties. This creates new challenges in terms of financial regulation, because if you make a mistake on the price of your housing stock or your stock market, if you make a 10% mistake on the price of your assets when your ratio of wealth to income is 7 years or 8 years, this is going to have huge, devastating consequences on your economy. Whereas when your wealth to income ratio is 200% or 300% in 1970, making a 10% mistake is going to be much less dangerous. So having wealth to income ratios that are higher raises new challenge for financial regulation. So we all know the problem in Europe with the fact that the regulation of the banking sector was not unified until recently, so this creates lots of uncertainty and linkages between private sector risk, public sector risk, etc., etc. So that's part. I think this is the kind of data, by the way, which until recently was not available. Here we use national balance sheets, which are computed now by most statistical institutes in the world, but that's very recent. Like in Germany, the first complete national balance sheet of assets and liabilities was produced by Destatis in 2010. So, before the crisis, we were not even able to compute this kind of yearly evolution. And I think, it could have been useful, for the European Central Bank, to see, in 2004, 2005, that Spain was going way out of the graph. Everybody knew, of course, that a real estate price index was going up in Spain. But if you don't have a reference point, if you don't know where you start, so it's important to have a denominator, to compare the value of assets to something, and the most natural point of comparison is GDP, national income. So if you really need to be able to measure both the stock and the flow, wealth and income, and that's what I try to emphasize in this work. Now, this has consequences. Rising value of private wealth has consequences not only for financial regulation, this also has consequences for taxation and inequality, because in practice, wealth is very concentrated, and typically for the new generation who want to access property, if you want to buy real estate assets and to buy an apartment in Madrid or in Paris or in London at the end of the period, and if you only have your labor income and you don't have family wealth, that's going to be much more difficult than at the beginning of the period. So this has strong consequences also on access to property for young generation who don't have family wealth to begin with. So the best policy reaction, if we had perfect policy maker, is that when you increase wealth to income ratio, probably you should tax labor income, in particular labor income of the new generation, a bit less, and tax accumulated wealth a bit more. You should rebalance the tax system so as to counteract a little bit this evolution. Now the problem is that it's exactly the opposite that has happened because of competition, in particular between countries, and lack of fiscal coordination, in particular between European countries. We tend to do the opposite. We tax wage and labor income more and more and more, and a lot in Belgium, a lot in France. So we know what we are talking about in our two countries, and we tend to tax wealth less and less, partly because some countries tend to try to steal the tax base of their neighbor, and you also know a lot about this in this country. Now, let me describe another part of the story, which I think is also very important for our European discussion, which is the relation between private and public wealth. So here on this graph, I have put, so we still have the private wealth to income ratio, and we have public wealth to income ratio. So again, this comes from the official national balance sheet computed by the central banks and statistical institute of each country. So we've put everything together with Gabriel Zuckman so as to make it comparable, but this is basically the official data and nothing more. We just put it in a way so that we can make comparison. So what is public capital? Public capital is defined in the same way as private capital. This is the difference between assets and debt. Okay, so you take public assets, which can be public buildings, this can be public financial wealth, if you have a big sovereign wealth fund, minus public debt. Okay? And so this is the net value of public wealth relative to national income, and this is the net value of private wealth. So what can we see on this graph? Well, first of all, you can see that private wealth is always a lot more than public wealth, which is not surprising because these countries have never been communist countries. We all know this, but it's good to check from time to time that we've not done anything wrong. So we've not done anything wrong. Private wealth is always the majority of wealth. Now the balance between the two has changed. So what you can see on this graph is that you have a big increase in private wealth, and you have a decline in public capital, which in some countries now it's even negative. So look at the case. The case of Italy is quite interesting because Italy, which is a black square, they are at the top of private wealth and the bottom of the public wealth. And of course, the two are related, because why are they negative public wealth? Well, it means that according to the official Bank of Italy data, even if the government was selling all the public buildings, all the public schools, public hospitals, this will not be enough to reimburse the public debt. So they have negative public capital. This means they have more debt than assets. So they will still have about minus 60% of national income. So national income is almost GDP. It's about 90% of GDP, but you can think of it as GDP if you prefer. What has happened over this period is that many governments, and in particular the Italian government, they have increased their public debt and they have reduced their public assets through privatization. So if you have less assets and more public debt, of course, you reduce your public wealth. Now, who has bought the privatized asset and who has bought the public debt? Well, very largely the Italian household sector. And this is why private wealth has gone up. So, the fact that you have at the same time a decline in public wealth and increase in private is perfectly logical because, someone has to buy the public debt, the privatized assets. We are not owned by the Mars planet. Someone owns the public debt and someone owns all the assets that are being privatized. Now, the good news is that even in a country like Italy, the increase in private wealth has been a lot bigger than the decline in public wealth. So if you look, I put the number here, I don't know if you can read, in Italy, private capital rose from 240 to 680% of national income between 1970 and 2010, while public capital dropped from plus 20 to minus 70. So the drop was about 1 year of national income, the increase was more than 4 years of national income. So it's only 1/4 of the increase in private wealth which can be accounted for a transfer from public to private wealth. So, this is good news because this means that, sometime in Europe today, we do as if, we say, okay, we have this big increase in public debt, we are going to leave all this public debt to our children, we should be ashamed, this is very bad, and, of course this is very bad, etc. But at the same time, we are going to leave more private wealth to our children than we've never left to our children, at least for those of us who have private wealth to live. So, and the increase in the private wealth to national income ratio has been much bigger than the decline in public wealth and the increase in public debt. So in other words, we are rich countries. It's our governments which are poor, which creates a number of difficulties, as we know very well in Europe, but it's a much better situation than if we were all poor. And I think it's important because sometimes, I don't know in Belgium, but in my country, in France, sometimes people sort of imagine that we are being owned by the Emir of Qatar or the Bank of China, or, and maybe this will happen one day if we keep having bad policies in the Eurozone, but at this stage, this is not the situation. At this stage, let me insist that the financial assets that Eurozone residents own in the rest of the world are bigger than the financial assets owned by the rest of the world in the Eurozone. So in other words, our public debt is entirely internal. Or more precisely, the fraction that is owned elsewhere is less than what we own in the rest of the world in financial assets. So, together, in fact, our national wealth, which is the sum of private and public, has actually increased. So it's entirely a problem of internal organization, how we coordinate our tax system, our regulation system, our monetary system. So this is a much better situation than if we were just owned by the rest of the world. But this is not the situation. So it's important to look at public debt, but it's important also to look at private assets and to look at the entire balance sheet of the country if we want to have a real appreciation of what's going on. Let me, I'm going to go much quicker on this, maybe this is another illustration of the book on the diversity of capital relation and property relation. So this is a very extreme form of property. But this shows, this illustrates that, the US historically as a country has a complicated relation with inequality. In some ways, as I said before, it has been historically more egalitarian than Europe, but in some other ways, it has been much more inegalitarian and much more violently inegalitarian. So here you can see the contrast. So in the north of the US, this is what Tocqueville describes as the land of opportunity, the land of democracy, where land prices are so small that everybody can become an owner of land. And according to Tocqueville and Jefferson, this is part of the reason for the rise of the democratic spirit in America. And indeed, if you compute the value of the land in black, this is much smaller as a fraction of national income than in Britain or France. So, of course, you have more land in volume in America, per inhabitant, but you have so much more land that the value of land, the price per acre is ridiculously small. So everybody can easily become an owner. So you cannot be very rich by being a landowner. Except that in the south of the US, people have the good idea to own also the people who work on the land. And then you can be very rich. And then the total value of private wealth is as large as in Europe, but with the property relation, which in many ways is much more violent than the relation from landowners to peasants in Europe. So, property, so this is far away, this is not really relevant for today, but I think it's important to realize that all property relations in general are complicated relations. This one is the most extreme, but, generally speaking, the view that we have sometimes in economic textbooks that, property relations are always mutually beneficial and harmonious, and in order to develop, poor countries should just receive a lot of investments from rich countries. Well, property relations are always complicated. So paying rent to your owner is always complicated. But when it's a country paying rent to another country, or it's a really complicated relation. So I try in my book to show that. All property relations require careful examination. Of course, we need private property, but we need to design it, to regulate it, to limit the power of owners and allow new groups of the population to access ownership so as to build an harmonious society. Last example, if you look at capital and inequality in Germany, you have a disconnection, a big gap between the market value of companies and the book value of companies. So I already mentioned the fact that Germany had lower housing prices than many other European countries, but this is in a way even more true for the relative value of company. So when you compare the book value and the market value of German corporations, you always have a substantial gap, which many people associate to the idea of co-determination or stakeholder capitalism. So apparently this does not prevent German companies from producing good cars, at least until recently, but I think, look, in my country, in France, for a long time, employers didn't want to have worker representative on board because they say, well, workers on board, they do all sorts of stupid things. And so at some point, people told them in France, well, look, in Sweden, you have 1/3 of the board that are made up of worker representative. In Germany, it's 1/2, and, apparently this is working. So there was a law 2 years ago which introduced one board member representing workers for each company, which is still very far from Sweden and Germany. I think this clearly illustrates the fact that market and social values of capital can differ, and that property relations are socially, legally, historically determined, and these are important issue not only in the manufacturing sector, but the future of the media sector, education sector, all sectors involves new form of governance and participatory governments and property, which the world does not end with the shareholder company and all power to shareholders. So this is just the ratio of market value to book value of corporations. So in the textbook economic model, this should always be equal to 100%. Now you can see that in Germany, this is typically much less, in US, UK, much higher, and this partly illustrates the co-determination effect I mentioned. Let me move now to the last point about wealth inequality in the long run. So far, I did not really talk about wealth inequality. I talked mostly about the total value of private wealth, public wealth, but I didn't really say which groups is having what share and how this is changing over time. So the point I will make for my last part will be that one of the important determinants of wealth concentration in the long run is the gap between the net of tax rate of return to wealth, R, and the growth rate of the economy, G. And when you have a higher gap, this tends to lead, other things equal, to higher wealth inequality level. And I will argue that this one of the solutions, probably the best solution, is to have more transparency about wealth and ideally more progressive taxation of net wealth. So let me illustrate this by looking at this table. Okay, so this is data coming from Forbes magazine global rankings of world billionaires. So let me say very clearly that this data is not particularly reliable. And, you know, I'm not... Look, this is a bit sad that we have to read magazines to learn about wealth. You know, I would prefer to read Eurostat publications or IMF publications or European Central Bank publications, but, you know, unfortunately, you will not find the information because all these institutes, you know, they keep measuring wealth without serious administrative reporting of wealth. So they just do a household survey where they ask individual, what's your wealth? And then, of course, they don't get the good answer, especially for the top of the distribution. And so, you know, they should be using, there should be, you know, automatic transmission of information about wealth, administrative reporting of wealth, use of tax, fiscal and bank data. In the meantime, you know, we have to do with what we have, and I think in particular if you want to do at the top of the distribution of wealth, what these magazine rankings are showing us is probably more reliable than what we have in household surveys. So let's see what we have. So here, you know, what I've done is the following. Usually when people look at this billionaire rankings, you know, they just say, okay, you have more and more billionaires every year. But this is not too surprising if you have a growing world economy with, you know, 3% per year growth in GDP plus 2% inflation. You know, if you have 5% nominal growth in the economy for 20, 30 years at the world level, of course you have more billionaires. You know, there's nothing. What's a bit more interesting is to look at this. You know, you take, and world population also is rising, so that's another reason for having more billionaires. So here what I do is a bit more sophisticated, not very sophisticated, but slightly more sophisticated. I take a fixed fraction of the world population. I look at the average wealth of these top groups, and I look at how fast this is rising in real terms, so net of inflation. And so I started in 1987 because this is when Forbes started publishing their global rankings of world billionaires. And so what you see is that these top groups, the average rate of this top group has been rising at 6 to 7% per year, which is 3 to 4 times faster than average wealth and average income in the world. So world GDP has increased at 3.3% per year over this period, but it's important to have in mind that world population growth is taking half of this growth away already. So you know, population growth is supposed to go to zero in the 21st century, but we're not there yet. And right now we still have about 1.5 growth rate for population, and if you take adult population, it's even more because you have aging going on. So in the end, the per capita, per adult average world income has been rising at only 1.4%. You know, in spite of China, in spite of emerging countries, it's only 1.4. Average wealth per adult has been rising at 2.1. Well, this is because of the rise in the wealth-income ratio. So wealth is rising a bit faster than income. But, you know, 1.4, 2.1% per year. So this is how the size of the world economy is rising. Now, the top wealth levels are rising 3 to 4 times faster than the size of the world economy. Now, of course, this cannot continue forever. You know, because if this was to continue forever, then the share of world wealth going to billionaires will go toward 100%, which, you know, I think everybody would agree will be too much. And you know, look, I'm not saying it will go to 100%. I'm sure it will stop before that. You know, it will stabilize at some point. Now, where exactly will it stabilize? You know, nobody knows. And I think this is an issue in itself because, you know, if when you go up 3-4 times faster than the size of the economy, you know, this can go very fast. Okay? So let me stress that, you know, of course you have a lot of mobility. So sometimes some people say, well, you know, this is not a problem, this inequality is not a problem because, you know, these are all new entrepreneurs who are becoming rich and that's perfectly fine. These are not the same people over time, you have mobility. Now, of course you have mobility, but this is not a reason, a justification for average wealth at the top rising permanently 3-4 times faster than the size of the economy. You know, let me make sure that, you know, between 1987 and 2013, of course, these are not the same people. So, you know, in 1987, the top billionaires of the world, according to Forbes, were Japanese billionaires, which everybody has forgotten their name today. In 2013, you have Carlos Slim from Mexico, you have Bill Gates from the US, and that's perfectly fine. This mobility is very good, and you know, you have people who have invented new technologies. That's perfectly fine. But first, this is not a reason for this to happen, because, you know, the fact that you have people who go down, people who go up, in principle, these two effects should balance each other, so that on average, the average wealth of this group should rise more or less at the same speed as the size of the world economy and average wealth in the world. You know, it's perfectly fine to have top people, bottom people, but everything needs to grow more or less at the same speed in the long run. So these two effects, you know, should compensate each other if we were in an equilibrium of the cross-sectional distribution of wealth at the world level, which clearly we are not. The other important thing to realize is that, of course, you have entrepreneurs in this top wealth group, but, you also have people. Carlos Slim in Mexico, he did not invent the cell phone. He became owner of the entire telecom sector in Mexico, partly because privatization was made at very low prices. And you have a lot of the big private wealth owners in the world today. If you, in the top rankings, you have people from Russia or people from Gulf countries, who, they did not invent the oil or the natural resources. They became owners of big part of natural resources just as a transfer from public to private wealth. You also have, a lot of inherited wealth that is growing very fast. So, you have the famous story in France of Liliane Bettencourt's wealth, has increased in this period exactly in the same proportion as Bill Gates. Bill Gates has gone from 10 to 50 and she has gone from 5 to 25. So, you have exactly, which is very sad in a way, because we would all like, of course, the growth of the wealth of Bill Gates, to increase faster. But, sometimes, wealth is not only about merit. Sometimes you have scale effects in wealth management. So to illustrate this, let me show you, this is the last table I will show you. Data on the capital endowments of US universities. Now, I'm not showing this to depress you, and I know that Leuven is a well-funded university, there's no problem. So, the only reason why I am talking about universities now is just because these people, at least they publish data. So, the Forbes people, the Forbes billionaire, we really don't know anything very precise about them. We don't know what they do with their wealth, we don't know. At least, university endowments in the US, they publish, they disclose their financial statements, they tell us exactly how they have invested their money, so you can see why they grow at the speed they grow. So you have 850 universities in the US with capital endowments, and between 1980 and 2010, the average rate of return, net of inflation, net of all administrative costs and management fees, has been 8.2%, which is quite good. If you go to your bank with 10,000 euros, so, according to the textbook model, again, of economics, with a perfect financial market, even you go to your bank with 10,000 euros, everything will be invested in China the next morning, you will get the world marginal product of capital and the world production function, and everybody should get the same return. The real world doesn't seem to work exactly like this. You have rates of return which can be extremely high for high portfolio, and you can see the higher the initial endowment, the higher the return. So why is it so? Now, if you look at what they do with their money, first of all, it's important to see that, clearly they don't buy US Treasury bonds. There are people in the world, in Saudi Arabia or China who buy US Treasury bonds. I don't know why, but I can tell you that US universities, they have not bought a single US Treasury bond for over 30 years. And so what do they do? Well, they invest on the stock market, but even more so, they invest in private equity, so firms that are not on the stock market and for which you need a lot of information. If you invest in China or in Brazil in private equity, they invest in financial derivatives, in commodity derivatives, so very sophisticated financial products for which you need a lot of advice and you have a lot of scale effects. You cannot just invest 100,000 euros or even 1 million. You need to invest a lot more. So they spend a lot of money on financial advice, but because of the scale effects, it's worth it. So let's take an example. If you take Harvard, right now they have an endowment of $40 billion. So they spend only 0.3% in management fees each year, but 0.3% of 40 billion is more than 100 million per year. So if you can spend 100 million per year to pay financial advisor, even if these people are very costly, you can buy a good group of financial advisors. Now, if by paying 0.3% of your capital each year, this allows you to get a return of 10 rather than 8 or 6, this is worth it. Okay? Now, if your endowment is 100 million, you're not going to spend 100 million each year, your entire capital, to get advice. Okay? And if you have 10,000 or 100,000 euros, you can ask advice to your brother-in-law or your friends, but that's probably not going to get you very far. Okay, so now, if this was happening only to university endowments, after all, maybe it will not be that bad because Harvard, Princeton are doing lots of useful things with the money, so that's okay. Well, this tends to create inequality between US universities and this can raise issues. But the problem is if this applies also to individual wealth dynamics, you can see that this can be a powerful force that tends to lead to very high concentration of wealth and to a level that is just excessive. You know, if you want the middle class, you know, remember the concern is not really the level of top wealth per se, but rather the share going to the middle class. If you want the share going to the bottom 50%, if you want some access to property, you know, having this kind of extreme concentration of property at the top, there's no evidence that this is useful for growth. You know, if you look at the most extreme concentration of wealth that we have in history, say until World War I, well, this was hugely reduced during the course of the 20th century, so that there was much less inequality in 1950, 1960. Was this bad for growth? Well, certainly not. This probably increased mobility. New groups were able to access responsibility, and in the end, you know, extreme concentration of wealth. This has to stop somewhere. You know, you cannot have the top rising 3-4 times faster. So the ideal solution, of course, and I'm going to conclude there. The ideal solution for regulation of wealth inequality here will be a progressive taxation of wealth, which is also a way to produce information about wealth. So, you know, if you had information on how these different wealth groups are doing, you know, you could see, you know, maybe this Forbes data is overestimating what's happening at the top. Maybe it's underestimating. What matters in the end is not really what's happening for billionaires, but rather what's happening at the level of 10 million, 100 million, because this is where you have a lot more people. And, you know, I have no, look, if we had better information, if we have, all what I want is more transparency. If we had more transparency and if we were to observe that the top is not rising faster than the average and it's rising at 1 or 2% per year, you know, I'd be very happy to conclude that we don't need very progressive taxation. But if what we observe is this, you know, you cannot say that a 1% or 2% wealth tax rate at the top is going to kill the economy. You know, if they are rising at 6-7% per year over a 30-year period. So, you know, that's why it's important to have information, because otherwise, you know, in France, we had the discussion about the top rate of the impôt sur la fortune a few years ago, and it was reduced from 2 to 1.5 or 2.2 to 1.5. I think partly because of the competition with Belgium, but one of the other arguments that was given at the time was, you know, now the interest rates are so small, you know, how can you tax these poor people at 2%? But, you know, these people, they don't have treasury bonds, you know, they have a different kind of portfolio. So you have to look at the rate of return for the kind of portfolio that they have. You know, it does not make any sense to look at interest rate and public debt. Okay, that's not the kind of asset that matters here. So I think it's important, you know, to base this kind of discussion on serious data and more transparency. Now, will this kind of you know, can this kind of progressive taxation and more transparency happen? You know, let me just conclude by saying that the history of taxation is complicated and difficult to predict. So, you know, this is a brief history of income taxation. So this is the top income tax rate in 4 countries, US, UK, Germany, France. So you can see that a century ago, there was no income tax, or with very low tax rate, and many people were saying that the income tax will never happen, will never be created. And then finally it happened. So, you know, things happen in history, and you know, I'm not impressed by, you know, people who know in advance, you know, what's going to happen, what's not going to happen. You know, history is full of surprise, because the history of inequality taxation is not only an economic history, it's a political, cultural, social history, and you have lots of surprise. So look at, you know, US and UK, they had very, very high top marginal tax rate. So if you take US between 1930 and 1980, you have sometimes 91% under Roosevelt, sometimes 70% in the 1970s. You make the average between 1930 and 1980, you get 82%. And on the top of that, you had the state income tax, which were 5 to 10% in different taxes. This is only the federal. Okay? But this is, you know, with 82%, that's already. Now, apparently, this did not destroy American capitalism. Apparently, you know, because it happened for 50 years. Probably because this was applied only to extremely high incomes. Okay, so look, this top tax rate only applied to a very small fraction of the population, typically above $1 million in annual income. And the evidence is that, again, paying top managers 10 million rather than 1 million is not terribly useful in terms of productivity, job creation, investment. And this is probably the reason why this did not hurt US economic growth. And in the end, productivity growth in the 50s, 60s, 70s in the US was higher than what it has been since the Reagan years. So, in the last decades, you have rising inequality everywhere, except in the productivity statistics. If you had a huge growth rate, a huge growth performance, why not? But, per capita GDP growth in the US between 1980 and 2010 has been 1.7, 1.6 per year. So if you have 2/3 of this going to the top, is it a good deal for the rest of the population? I think it's a debate, that we should be able to have. Now, it's very difficult to have this discussion because people get very excited about taxation right away. But I think historical evidence is important because sometimes people don't even know that this happened in the past. And so I think it's important to have this in mind. For taxation of inheritance, you have a little bit the same story. So you can see that the US and the UK have gone much further historically to tax the transmission of large wealth than France and Germany. This is partly because in France and Germany, a lot of the redistribution was done through other ways, and through the wars, through destruction, through inflation. That's partly the reason I think was US and the UK used the progressive tax system more because, in continental Europe, the redistribution was done in different ways. I tend to prefer progressive taxation. This is more peaceful and more, I think, a better way to redistribute. Look, it's interesting to see the only time when you have a 90% tax rate in Germany, you can see that between 1946 and 1948, this is when the tax policy of Germany is set by the Americans. Okay, and but this is not a joke. This is real. This was the Allied Control Council that was setting the tax policy in Germany, and so when the German government took the German sovereignty back in 1949, 1950, they reduced the tax rate immediately down to 50% because they didn't want to continue with these crazy American levels of 90%. And so what's interesting is that you have the same in Japan. You have 90% in 46 to 48 when the Americans set the tax rate. Now, the Americans were not doing this to punish the Germans or the Japanese because they were doing the same thing at home. So this was not a punishment. In the American view of the time, this was part of the civilization package. You bring democratic institutions together with fiscal institutions that will prevent democracy from becoming a plutocracy with extreme concentration of income and wealth at the top. So I know this looks like ancient history to you, but this is not so far away. This is part of our history. And I think, what I want to convince you in the end is that, all this discussion about taxation, inequality, public debt, growth, they need to be much more informed by historical evidence. In every country, in particular in my own country, but this is true in Germany today, people tend to have a very sort of nationalist view of history. They feel that they are unique, that they cannot learn from other experience. But, I think, there's always a lot to learn from others' experience with public debt, with progressive taxation, with inequality. So let me conclude by, saying that the history of income, wealth, inequality is much more than an economic history. This is always deeply political, social, cultural. It involves belief system, national identities, sharp reversals. In a way, both Marx and Kuznets were wrong. Marx was predicting ever-increasing inequality, Kuznets' natural reduction in inequality in advanced stages of development. I disagree with both because I think, there are powerful forces. This is what I say right from the introduction to the conclusion of my book. There are powerful forces pushing in both directions, either rising or reducing inequality. And, the diffusion of knowledge and education can reduce inequalities. This is working to some extent in the world today with the rise of emerging countries. But you also have powerful forces that push toward rising inequality. And in the end, which one dominates really depends on the institutional policies that different societies choose to adopt. The ideal solution, certainly, there's no magic bullet. It's a broad combination of inclusive institution, including education, minimum wage, financial transparency, progressive taxation, economic democracy, co-determination. You know, sometimes people tend to oppose this solution and say, okay, we just need to invest in skills education, we don't care about progressive taxation. But, you know, we need all of them. We don't have to choose. We need all of them, and we need to have a serious discussion about how far we want to push all of them. Of course, there are other solutions to deal with inequality. So, you know, in Russia and China, you have a lot of inequality, large billionaires, and the way they deal with it is, you know, I think not so efficient. You know, they typically, you know, they put in jail 1 or 2 billionaires from time to time, but, you know, there's very little, there's very little transparency. Many of these billionaires, especially for Russia, but this could happen in China as well, are having a good life in Paris or London or other parts of Europe and taking away dividends from the Russian economy, and this could happen one day to China as well. So I think, you know, progressive taxation and transparency about income and wealth is a much better way to regulate inequality. And, you know, otherwise, there's a risk that big groups in our population feel that globalization is not working for them, is only working for small groups of the population. And I think this can lead to a major threat to the globalization process itself. So let me stop there and thank you for your attention.
So given the time, there's time for 1 or 2 questions. So if there's somebody who wants to take the lead here, feel free. There's a question in the back there. Please, they come with a microphone.
Thank you for the session. My question is that, can we say that public capital is shrinking because sometimes states choose that way to act, as an increase in private capital causes a shrink in public capital? Can we say that?
Oh, yes, certainly. This is always a choice. And, you know, sometimes for good reason. Look, you know, sometimes privatization, there can be good reason for privatization. You know, sometimes the government is not a very good manager of capital. So, you know, it can be justified to privatize sometimes some assets. Now, in some other sectors, you know, when you privatize the railway system in Britain, you know, did it work very well? You know, I'm not so sure. So, you know, sometimes privatization goes too far, but certainly it's always done on purpose. You know, the problem is that many of these privatization policies, you know, in order to please the buyers of formerly public companies, you know, they were done at very low prices, at least at too low prices. So in effect, this induced transfer of wealth, which are less extreme than what we see in the same period in Russia, in the ex-Soviet Union, where really you have pure transfer of public wealth to private wealth, but still which were in some cases, I think, excessive. Now, the rise of public debt, was it voluntary? Well, you know, it's always possible to pay for your public spendings with more tax rather than with public debt. And so in the short run, there's always a reason why you prefer debt rather than tax. But, you know, in the long run, this is contributing to reduce net public wealth, so that in the end, you know, look at the case of Italy. You know, you have, I said, you have negative public wealth. So, you know, you have more public debt than public assets. So, you know, even if the Italian government was to sell all the schools, all the hospitals, you know, it will not be enough to reimburse the public. Now, this is really reducing the ability of the government to conduct policy and to play its role. So, you know, I'm certainly not saying they should sell all these schools and hospitals, but it's important to realize, you know, many of us will be shocked if we had to pay rent to the private owners of the schools and hospitals to which we send our children. But when you have a huge public debt, which sometimes is bigger than the value of the public school and hospital, in effect, this is already what we are doing, because you can end up paying in interest payment, you know, more than what you would pay in rent to the owners of the school. So in the case of Italy, interest payment right now are 4-5% of GDP each year, and total budget of the entire higher education system is of the order of 1% of GDP. So is this the right way to invest in the future? When you put 4-5 times more resources into repaying debt to ourselves rather than investing in the future. So I think the decline of public wealth to very low level is in the end a mistake in the long run. And this, this is really limiting the ability of government, particularly in Europe, to invest in the future. And I think this is why, what we should do is a little bit what we did already after World War II in the 50s, which to have a huge debt moratorium and to keep the money to invest in the future, invest in particular in higher education. Just one number, we all like Erasmus a lot, and maybe there are Erasmus students here, and that's fine. But the total budget that we put into Erasmus each year in the European Union is 4 billion euro per year. Total interest payment in the Eurozone, 400 billion euro per year. So, I'm not saying we should exactly invert the two numbers, but still, I think we should increase the 4 and reduce the 400. What's the best way to prepare for the future? I think that's investment in higher education, investment in knowledge, not repaying debt to ourselves, because as I say, this is internal debt in the end, if we take the Eurozone as a whole.
Thank you very much. Thank you for the lecture. The crisis in Europe has increased a lot the conflicts, as we have seen, between the member states. So who has the better model, Germany or Greece, France or Spain, the Baltics or the Mediterranean countries? You mentioned bad policies in the Eurozone, the lack of fiscal coordination in the EU. My question to you is, to get out a bit of this situation, what would be your number one, maybe priority, or number 1, 2, 3? I'm a federalist. We believe in European Economic and Monetary Union budgets. We believe in a fiscal union and economic government. Are you in favor of those solutions, or do you think that it's more intergovernmentalism that will find a way, that our leaders, Merkel, Hollande, that we heard yesterday, have the answer? Or would you join us and declare yourself as a federalist as well?
Right, so, first, who is right between, Germany and France and Spain and Italy? Well, look, I think in the end, there are much more common points between the different European social models than between European social models and the rest of the world and China and the US, etc. So I think, we lose a lot of time, fighting against each other. And in the end, we have done a very bad job collectively after the 2008 financial crisis. If you just compare Europe with the US, it's very simple and it's very sad for us. The level of GDP in the Eurozone today, 2015, is still less than what it was in 2007. We still have not recovered. Whereas in the US, they are 15% higher. So, it's a disaster, basically, because we have transformed a crisis that initially came from the US private financial sector into a public debt European crisis, in spite of the fact that there was no more public debt in Europe to begin with as compared to US, Japan. So this is entirely our fault. Entirely because of our dysfunctional institution policy making. And this is a huge responsibility, because now it's almost 10 years that we have lost. So then we can talk about, who is wrong, who is right. We all made mistakes. So take, Germany, of course, there's a lot to learn from the German social and industrial models, and, the recent news about automobile industry, of course, will not change this. We should all, be happy that Germany has been so successful with its reunification and industrial model. But this is not a reason just to keep giving lessons to the rest of Europe all the time. And I think Germany has to understand that they themselves benefited from huge debt restructuring in the past. In the 1950s, if you take the German external debt that was restructured, brought down to zero in 1953. This is a much bigger share of European GDP of the time than the Greece public debt of today. So, there's a level of historical amnesia in this discussion, which is simply not acceptable, because in the end, this is bad for everybody. So I think, what's the solution? Well, as I said, the solution should be, in the end, quite close to what we did already, in the 1950s, which is that we should have a huge debt moratorium. So, in the case of Germany in 1953, remember, it was not entirely cancelled. What happened at the London Debt Agreement of 1953 is we said, we'll talk about it later. For instance, when you have German unification. And then in 1991, we started discussing again, and we said, oh, now it's too late. And, with the inflation and the growth, because there was no indexation clause to begin with, nobody cares about the 1953 amendments. So should we have the same today? Well, you don't have the equivalent of the unification, but I think we should have some target in terms of growth. We should say, as long as European GDP, and in particular GDP in Southern Europe, Greece, Spain, Italy, does not recover from 2007 level, and if possible, gets back to a growth trajectory, 1%, 2% per year as compared to 2007, the priority should be to recover, to invest in growth, to have a Eurozone budget, to invest in university, in public infrastructure, and we should have a debt moratorium until we have recovered, because it's irrational to keep asking austerity to countries whose GDP is 20% below the level of 2007. Even as a creditors, how do you want to be repaid by a country whose GDP is 20% below? So, I can tell you the new targets that were set up for Greece this summer, this will not happen. The idea is that Greece will have 3.5% of GDP in primary surplus in 2017 and will stay there for the next 30 years. This will not happen. So this is stupid to put that. So why is this happening, and when is this going to change? I think we need a much more democratic governance in the Eurozone with public deliberation. So I think we need a Eurozone parliament. So some people would like to see, the Eurozone countries in the European Parliament to sit separately, to have public deliberation about Eurozone affairs. But to me, I think I would prefer to have a separate parliamentary chambers for the Eurozone countries that want to participate to further political integration, with each country will be represented in proportion to its population, through its national parliaments, in proportion to, for instance, to the different political groups in each national parliament. And I am convinced that we would have had less austerity and better policies with this kind of public deliberation in a Eurozone parliament. The kind of behind closed doors decisions that were taken again on July 12, where you make, the head of state, the finance minister sit for an entire night. And then in the middle of the night, they tell you, oh, we have saved Europe. And then, you realize during the next day or next 48 hours that they don't even know what they have decided. And that, of course, they have not saved Europe. What's this idea of having a privatization fund of 50 billion euros in Greek assets in 3 years? Everybody knows that it's just impossible in the state of the Greek economy to generate 50 billion euros in sale of public assets. Or if you want to do that, it means you will have to sell public assets at extremely low prices. And the people who will buy, either from Greece or from Germany or other countries, these are the people who should pay tax. And we are going to make them buy public assets at very low prices. This number, privatization fund of 50 billion euros, this was invented in the middle of the night without any public deliberation. At least in a Eurozone parliament or in any parliament, you have to put your argument on the public table. You have to say publicly. Whereas with the governance we have today in Europe, everything is intergovernmental. So you have one individual, either the head of state or the finance minister, who is representing an entire country, France or Germany. So of course, when you have one individual to represent 80 million people or 60 million people, how can you have peaceful public deliberation and majority decision making? It's just impossible. So it's really our institutions that are pushing towards this clash of national self-interest, and who are pushing also toward inertia, because most of the time we just don't do anything. And we just wait, and the recession is still there in many ways. We already have a lost decade. So, I think this is a very bad situation, but there are ways to change Eurozone institutions so that we take better decisions. Again, I think, Germany is about 25% of the population of the Eurozone, a bit more for GDP, like 28 or 29%, I think, of voting rights in the European Stability Mechanism. That's an important share. But you have 3/4 which are not Germany. If you take Italy, France, Spain, you have 50% of the Eurozone population and Eurozone GDP. I think if we had a Eurozone parliament where each of these countries was represented in proportion to its population, or in proportion to GDP if you want, but I think population makes more sense. I think we would have had different decisions. And most importantly, I think this would have been more democratic decision, because if you have 20 or 30 parliament members from each country representing Germany or France or Italy in proportion to population, then you will have people from the left, people from the right, and they will not have the same opinion. So instead of having Germany against Greece, against France, you would have more political decisions. But as long as we don't change this institution, we will keep having this summit where in the middle of the night some crazy decision come, and we know that they will not be applied. Everybody knows that the plan for Greece of this summer will not be applied. You talk with people, they tell you, oh, of course we will not apply it. Of course there will be debt restructuring at some point, but we don't want to talk about it now. Okay, well, what are you doing? So, this is a disaster, because I think, the European social model, is one of the best models in the world. We have lots of very strong assets, not only our more egalitarian education system, which we talk about, social institutions, but even our financial strengths and our macroeconomic and financial fundamentals, as I have said, are much better than what we sometimes imagine. So it's really a bad internal organization that's causing this. So yes, I am on your side for European integration.
I think we could listen for the rest of the day to you. However, we have a very, very tight schedule. Before we thank Thomas last time again, let me end with 2 practical announcements. For those who had the good fortune to be able to go to the reception, there's a little map in the email sent to you. And then secondly, the smooth organization of this event today would not have been possible without Carla van der Weyden, who is the administrative coordinator of the Department of Economics. So let's thank Carla and Thomas for this very nice event.
Okay.